Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Hi everyone, welcome back to another Bondcast. A bit of a quieter week this week after a busy few weeks of lots of central banks and lots of data. So it's nice to be able to take a little bit of a step back this week. But it's still been, I guess, volatile markets. We've had gilt yields going up and down, Theo. So what's been driving this volatility?
Yeah, I think it definitely has been a very exciting time. We've touched 0.75 and then we've gone all the way to 0.9 at the 10-year pod. And right now, as we speak, we're back to 0.73. So we talk about a big round trip with strong emotions, a lot of happiness. Well, for us, because we're still on the bearish side, but also moments of skepticism because of that pullback. What is driving this volatility? Well, there are a lot of technical factors. First of all, next week is a very particular week. We have net issuance being deeply negative. So basically it's the QE purchases only. And this is really the end of the quarter. So nothing has been scheduled. So because of that imbalance, there is ample investor fear that this scarcity can cause, gilt yields to return substantially. This is one. The other point is index extensions. And March has been very well known as a month of index extensions. Some investors follow indices that rebalance right on the day of the extension, and that was the 7th of March. Other investors, however, rebalance at the end of the month. So there is still a perception that there will be buying over the next days into the month end and quarter end, and this is supporting yield valuations now. So this is why we see this particular pullback.
Okay, so how are we positioned then going into the next week? You mentioned a couple of reasons why we might see a bit of a pullback in yields, but I noticed that you said at the beginning that you're still bearish and still have that 1% target 10-year, I think. So how are you positioned now?
Yeah, I think it's really, so when we reached 0.75, we said, look, maintain the bearish view, but have ammunition also to add. So the message was, run it at 50% of the risk. Now we are close to a point to say, add again that other 50% of the risk. So just be full bearish. So I think we'll look obviously at the data and everything and how it plays out next week, but we're keeping an eye to sell any strength in fixed income and to add to the bearish position. I mean, things, to be fair, will be shaky because the outlook is less clear with regards to there are some hesitations with vaccines, mutations of the virus, and the timing of the reopening, and we've been too optimistic. So it will be volatile. However, moments such as next week should be used to increase and intensify somebody's bearish bias on the fixed income market. So the bearish narrative is alive and kicking.
Nice, I like it. Getting ready to double down on it. That's what we like to hear. So just quickly then, before we move over to the US, we had yesterday, we're recording this on Thursday, we had inflation data yesterday, which came out, beat expectations. So can you just update on, on the data, what was driving it and what that means for rates as well?
Yeah, absolutely. I think this was a moment of that disappointed some of the optimists because, in particular, the CPI numbers came well below expectations. So CPI came at 0.4% year on year, RPI at 1.4%, but our expectations were more for CPI to be close to 0.8. So we talk about a chunky 40 basis point undershoot. Why that? To a large extent, it's methodological. And to a large extent, the changes in the weights and the composition of those weights make, this inflation number be weak. also clothing and footwear. Apparently, we didn't spend enough on clothing and footwear. So this one point. Maybe we need to go and spend more. But on a on a serious note here, I think what it shows is that the seasonal patterns and everything that we knew in terms of spending and inflation, everything that we knew pre-COVID may be different post-COVID. And this is to me the interesting part. Now, what does it mean for the, as going to your question, what does it mean for the fixed income market? What does it mean for the BOE probably? I mean, the BOE, they realize that inflation is going up, but they are also cautious not to be overly hawkish. So that tiger that Mr. Haldane mentioned, the tiger of inflation that may need to be tamed, probably now is a young tiger, and the teeth are not sharp enough yet. So I think that inflation problem may probably take more time to develop than otherwise.
Okay, fair enough. Well, look, Theo, you don't have to tell me twice to go and spend more money on clothes and shoes. So I will do my bit, and let's see what difference I can make next month. So Blake, again, another kind of quieter week in the US. We had the Fed last week, which we had Brian on to talk about, and now we've got you back this week. So can you just update what you're thinking now, really, in rates?
Yeah, I mean, in some degrees, I was just kind of listening to Theo there and kind of agreeing with some of his comments on stance that also apply to the US in some ways. I mean, longer run, medium to longer run, we still think rates are moving higher, by year end, but it just feels like we are starting to find some kind of near-term stabilization. And I think, maybe the next 2 or 3 months could be a period where the sell-off, to the extent it continues, slows a little bit, and any gains are really a little bit harder won. And because of that, I mean, and the part that I was kind of agreeing with Theo is this idea of, kind of staying positioned for rates to move higher, but kind of a half risk, if you will, given that in the near term, things could be a little bit more slower going. But looking at any kind of rallies to really add to that risk or to, position a little bit more strongly. And it could be that we're seeing that right now. I mean, this week, I think it was pretty telling, that over the last week we've had, some things that kind of play into the longer run theme of rates moving higher. We had a FOMC meeting last week, which I think, delivered a very dovish message, kind of reinforcing they're going to allow inflation to run hot. We got a headline from the Biden administration that they're looking at a $3 trillion stimulus package. That's well above, I think, what most people in the market had kind of assumed as an initial sticker price for that stimulus. We were probably thinking something more along the lines of $2 trillion, even though it was very, very preliminary. So we got some kind of headlines around additional fiscal stimulus, and we had supply this week, and that really covers some of the major bases that I think were driving the sell-off for the last few months. And despite all that, we've still kind of stabilized, if not rallied, depending on where you're looking at on the curve this week. So it just seems like that, that impulse to allow rates to keep moving higher from investors has started to fade a little. And we've seen more people kind of interested in staking out long positions, a little bit more interest in, even if it's not going long, at least lightening up on the shortening side. So to the extent that we do get a meaningful pullback, let's, call it sub 160 in tens, that's, much like as Theo was kind of mentioning, maybe that's an opportunity to look at kind of adding to shorts and, really positioning for the longer run view, which is for rates to continue moving higher.
Okay, one thing I've just remembered that we did get news on this week. We discussed briefly after the FOMC meeting with Brian, but obviously we didn't get an announcement then, and they said it will come in the next few days, was around SLR, the leverage ratio, and that the Fed won't be extending those. Can you, I guess, I know this is a subject that you've looked at very closely. It's maybe a little bit niche, but can you just kind of give us your latest thoughts on that, how that kind of compares to what you're expecting and what that means for treasuries from here?
Yeah, SLR. I mean, for sure, it's a niche topic, but I think over the 2 or 3 weeks prior to the announcement that we got last week, it had really broadened out to become a much broader trading theme outside of, the kind of typical players that you would expect to be involved in that kind of stuff, and really, I think was wrapped up into, some of the market conversation around the broader price action, both in rates, swap spreads, a lot of focus on it. So I think it's worth kind of mentioning here. We wrote about this before the announcement and basically said that if they did not extend these supplementary leverage ratio exemptions, so if you remember, they have for the last year been exempting reserves held at the Fed and U.S. Treasuries from calculations of supplementary leverage ratio. Those were set to mature or expire at the end of March. And the thought process here was that if they are allowed to expire, we thought that at some point over the next year, as reserves continue to grow, both because the Treasury is kind of spending down their cash balance, which adds to reserves into the system, but also just because the Fed is going to continue to buy assets and create reserves. All of these reserves get dumped onto bank balance sheets, which just increases the leverage there as measured by supplementary leverage ratio. So the thought process that we had was that if those exemptions do not continue at some point over the next year, it could start to become a binding constraint, and we could see banks start to pull back in Treasury buying and other things, right? So that's why we kind of looked at that and said, if they don't extend these if they don't extend these exemptions, we could see this as something that would, cheapen up cash, both outright. So we would see yields increase, and also kind of weigh on swap spreads, because this would really be a cash-driven story. The one caveat we put on there, and this is a very important one, is that we said if they ended these exemptions without talking about something in the future or providing some kind of guidance that they're going to make some, permanent tweaks to these measures. And that's exactly what they did. So they they announced last week that they were not going to continue these temporary extensions. But the most important piece of that announcement was actually that they said, we understand that this could become a problem. They essentially don't want SLR to be the most binding constraint on banks. They want, some of the other regulatory measures they have that are more risk weighted. They want those to be the things that banks really focus on. They don't want supplementary leverage ratio to be the most important. So to keep it that way, they're going to look at more permanent fixes, whether that's kind of recalibrating the SLR. Maybe they make these, they come back and make the exemptions that we had for the last year. Maybe they make those permanent. We don't really know yet, but the point is that they did promise some kind of future relief. I shouldn't say promise, but they at least indicated that they are going to be looking at a more permanent form of relief. And that essentially neutralized the price action. So all of that kind of sell off in rates, move in spreads, a lot of those things that people were expecting on this announcement didn't happen, because we got that forward-looking piece that really kind of canceled out some of the negative effects that you might have expected to come out of that announcement.
Okay, so in the end, it wasn't as much of a story for markets, is it?
It wasn't, and it was kind of a quasi resolution, because yes, we got some clarity on what's happening to these temporary exemptions, but now everybody's just kind of moving forward already to start focusing on, we've already gotten a lot of questions this week about what our expectations are around this process that the Fed's going to do, where they're probably going to open up some permanent changes for public comment and start exploring various options. So now already people are kind of turning to that as the next focus. So it's a partial resolution and a partially in the rear view, but then another piece of it's just been kind of kicked down the road. So I think the more important part though is that we didn't get a big market movement around that announcement in the way that I think a lot of people were probably worried about, and a lot of investors were very nervous about.
Okay, just quickly, correct me if I'm wrong, but does this mean then that the SLR exemption will still end at the end of March as planned?
At the end of March.
Be a period of time, I presume, before they've kind of figured out what these permanent.
For sure. I mean, so the way the Fed usually does these processes is that, they'll come out with some kind of proposals, and that could be relatively quickly. It could be, within the next month. And then they usually leave it open for public comment for a period of time. They're going to close it, analyze the comments, come back with kind of a final proposal, and that'll probably be, the end of it. So we're definitely talking a period of, at least at the very quickest, you would think maybe 2 months, 3 months. So there will be a gap between when these expire. But the important thing is, and this is something we wrote about ahead of time, is that shouldn't matter all that much, because SLR was not a binding constraint for most banks today. The concern was always about what happens 2 months down the line, 3 months down the line, a year down the line, when reserves continue to grow, eventually SLR was going to become a binding constraint. But as of right now, most banks are not constrained by SLR. You kind of look at all of their the big banks, the GSIBs, if you will. If you look through their quarterly statements, earnings statements, you read through their transcripts, none of them were really hitting SLR as a binding constraint at this point. They didn't need this exemption to meet their regulatory requirements. So, having it expire on March, if we get a permanent solution, this summer in June or July, that gap shouldn't be that meaningful, because hopefully it will not become binding on a lot of these banks before then.
Okay, thanks, Blake. That was super interesting. So now over to Europe then, Giles. Contrary to the US and the UK view, we switched to be a little bit more bullish, very near term, kind of tactically after the ECB. It was sort of a flows driven view, I guess, thinking that we didn't really want to take on the ECB and their significantly higher purchase pace over the coming few weeks, particularly in April, which is typically in Europe a big redemption month, so quite a low net supply month already. That view seems to have played out quite well. So what are we thinking about it now? We said we'd update quite frequently and something that we'd monitor quite closely. So here we are. Now's your chance. Update us on what we're thinking on that bullish view.
Yeah, well, I think that's exactly right. We picked the moment to switch from quite a strong longer-term bearish view to a more positive view quite well. Not necessarily, it's working, but not necessarily for the precise reason that we had emphasized, which was the flows. I think that the flows matter. And just to give a sense here, it looks like the ECB is sort of put itself on a track. We only have 1 week of data really to go on here, but just extrapolating quite aggressively from that, it looks like they put themselves on a track to buy maybe 25 or 30 billion more per month in the bond market. And it's a little bit difficult, I think, just given what we know about the various sectoral stories, to see who would really sell that kind of that kind of quantity of paper to the ECB at higher yields, at lower prices than where we were. So I think we're probably going with it, but I would characterize this as a moderate to low conviction sort of view. Certainly the kind of thing we want to keep under review. Pushing in the same direction, of course, over the last couple of weeks, we've had, I guess, just people asking the question, we've had a big correction. We've had a whole load of fairly significant risk events. We've heard about the SLR, that was an important one. Also global central banks, the Fed and Bank of England included, not just the ECB. And, I guess the question is, what's the next big thing? And my expectation is that the next big thing is probably just, what it was before, but it just takes people a little bit of time to sort of just settle down and refocus on those themes. But I definitely think that recovery, reflation, those kinds of things, they are still the direction of travel. And actually, the latest round of data from Europe has actually been really quite conspicuously good, and I think that just keeps you sort of focused on really this as a theme of, well, we're looking for the right moment to probably to switch back towards being bearish, at least, unless something dramatic outside of that happens. But obviously, almost by definition, we don't know exactly what that might be.
So you touched on the fact that, yields have been rallying, not just because of the ECB, but a couple of other reasons. One of the big themes, perhaps for lack of anything else this week really to talk about, but one of the big themes we've been talking a lot to clients about and a lot internally is this kind of threat of a third wave in Europe. Some countries extending or going back into lockdown, and all of that against a backdrop of, a slower vaccine rollout in Europe anyway, but vaccine supply disputes, etc. I'm guessing from everything that you just went through about our bearish view and the more resilient data in Europe, that we don't think that this is a game changer for the 2021 outlook. Perhaps you could just talk us through that a little bit, because I guess markets are starting to worry now a little bit more than they were perhaps even 2 weeks ago about COVID again.
Yeah, I mean, first of all, I don't want to muddy the waters at all. I mean, we are bullish at the moment, but as I say, it's something that we are, looking for the right conditions to potentially turn around again. So just it's under review, but that's not the same thing as being bearish in the short term. Listen, I think the answer to all of that is, there's been quite a bit of pessimism around, mostly about vaccination rates in Europe for quite a while, and that hasn't really improved. I mean, last week we talked a little bit about the whole fiasco with AstraZeneca. That sort of thing is still a problem. But you and I, Imogen, we've looked very, very carefully at all the vaccine delivery forecasts and so on, and I mean, given the recent track record, I think it's only natural that markets question the forecasts, because they have been frustrated again and again. But it's important to note that most of the boost is coming from new manufacturers and Pfizer, and there's no particular reason to doubt either, to be honest with you. In fact, Pfizer's been pretty reliable. And so I think that there is every reason to expect the vaccination rates to pick up pretty dramatically and around the middle of next month. And again, and then the other question is, well, this third wave, and it's something which is, it's not a wave of the size that we saw just after Christmas. It's more a sort of swell, if you like. It is causing, I suppose, problems with hospitals in some regions, particularly in France and so on. But I think the thing to recall here is, the overall cost of lockdowns has come down and down and down and down. At the moment we're talking about regional lockdowns. Yes, the direction of travel is different to the UK and the US, where deconfinement is really the ongoing theme. So visually it looks like Europe is going in the wrong direction here, but actually it's coming from a starting point of being, at least compared to the UK in general, much more open. And I think that the signs at the moment are, well, we shouldn't. We've already talked about the data. We shouldn't be blowing this out of proportion at all. And I've said again and again, on these podcasts and elsewhere, that I still see every reason to expect Europe to sort of to open, fairly sort of confidently and sort of permanently on a similar time frame to other developed markets. I mean, there may be a delay which we'll measure in weeks at the most, maybe sort of month and a half, that sort of thing. But I still see, from I guess late Q2, reopening really being the absolute number one theme.
Let's hope so. I'll just add as well, because I was looking at the data a little bit earlier, and this, related to the vaccine story and the AstraZeneca kind of saga. One, I guess, concern that markets had a little bit was that this would really knock the confidence of the public in the vaccine. And actually, even in France, where they were arguably already the most skeptic about vaccines in general, and certainly the COVID vaccine. But then the survey earlier this week showed that they would have the kind of worst view of the Astra vaccine after the blood clot scare. But even then, although it's only been a few days of data, we can see that, the Astra vaccine clearly stopped for a few days, but has picked back up again, at the same pace as it was going before. So,
and it didn't spill over into hesitancy
exactly.
with respect to other vaccines, which I think was also an important point to emphasize.
Which is important too, because as you said earlier, most of Europe's supply is Pfizer. So, the Astra vaccine only makes up 25% anyway. But so just another positive to add on to the end of that. All right then, guys, we'll stop there for this week, I guess. It hasn't been a super busy week, but still plenty to talk about, and we'll catch up again next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.